Underpinning all of this is the Ghana card, which has become the backbone of national identity and KYC infrastructure, and has considerably lowered the cost of bridging finance and bringing people into the formal financial services sector. At the Bank of Ghana, we have chosen deliberately to regulate innovation rather than merely police it as a fact. Our regulatory sandbox, for those of you who are familiar with it, allows fintechs to test new products from digital lending to insurance technology under supervised conditions before they reach the wider market. Our directives on digital credit service providers, published this year, brings short-term digital lending under a licensing regime from the first time, and for the very first time, closing a gap that in the past allowed unregulated operators working in the shadows in a very fast-growing market. And our Cybersecurity and Information Security Directive, CISD 2026, is built for the realities of cloud computing, artificial intelligence in credit decisioning, and a threat landscape. I'm talking about cybersecurity and fraud that did not exist some 10 years ago. Now, I believe this addresses this misconception that regulation and innovation pull in opposite directions. In my experience, they do not. Regulation that is proportionate and predictable is one that accelerates innovation. Ladies and gentlemen, the Bank of Ghana continues to push the frontiers in spite of the achievements that we've talked about. Our ECD pilot, which is the digital central bank currency, continues to explore what a central bank digital currency could mean for a cash-light Ghana. But having completed it in the domestic pilot, we're now designing the ECD for cross-border settlements and wholesale payments, building a proof of concept we have already completed for cross-border trade. Our tokenization projects, Universal Trusted Credentials and Digital Semi-Ecosystem Fungible Tokens, are early, but they are real. And on the supervisory side, for those of you who we supervise, you'll be familiar with our Supervisory Intelligence Platform, or what we call the ORAS, Online Regulatory Analytics and Surveillance System, that allows the central bank to now see risks building in the system closer to real time rather than discovering it at the end of the year when it's too late to act. Another point that I think is worth noting is that the foundations of our financial system itself is being strengthened as we speak. All our rural and community banks are being converted into community banks under the revised Microfinance Sector Framework 2026. Now, this is a modernization of a model that has served this country since 1976. Apart from a few people who I know would have been born by then, I think most of us would not have been born, excluding me, of course. Now, our open banking and open finance frameworks are also at an advanced stage of development, aimed explicitly at unlocking finance for the small and medium enterprises that will decide whether Ghana's growth aspirations are realized or merely talked about, as we have said many years since I can remember to read. We say it's the engine of growth. Okay. Now that work, I believe, comes soon enough. But it also brings me to a difficult part of this conversation. Because I believe a speaker who only talks about what is working is doing only half the job. So let me be equally direct about where we still have shortfalls. I think the most persistent bottleneck is not technology, not at all. It is the financing gap facing the very SMEs our digital infrastructure was built to serve. Recent estimates place Ghana's SME financing gap at $4.8 billion annually. That's one of the most severe gaps on the continent, despite our comparatively sophisticated financial system that I just spoke to you all about. We have built extraordinary payment rails, but we have not yet built equally extraordinary credit rails. An SME owner in Kumasi can receive payment for goods in seconds through the instant payment. But they may have to wait 3 months, maybe more, sometimes up to 8 months or a year for a small working capital, because the credit consideration is not built on the same digital footprint. That just proved that she has capacity to receive and the fact that she operates a business. Ladies and gentlemen, that disconnect between transaction data and credit access, in my view, is the single largest unrealized opportunity in this room. And I want to stay with this for a moment, because often when we discuss this, we just mention it in passing and then we move on. But all of the efforts we have been making is intended to address this exact problem. The speakers talked about, and I think some of the contributors talked about the fact that Ghana does not have a capital shortage. I think it is an architecture problem. We have banks, we have pension funds, they hold assets under management in excess of 100 billion, and they continue to add every month and every year. We have retail investors, some of whom own private jets, as we have just been again reminded of. So capital is not the challenge. Our development finance institutions are also active. Risk-sharing schemes exist, founded precisely to close this gap. But what is not working is the architecture that makes capital available to the business that needs it. And there are 3 parts of that architecture that I think we should avert our minds to. So acceptable collateral in our financial system is one of them. It means land, buildings, equipment, and cash, financial instruments that are easily convertible to cash. These served us well in the past, but a lot has changed since then. A great deal of value being created in Ghana today sits in contracts, in the digital rails, in receivables, in transaction histories, rather than in fixed assets. But our systems have not yet caught up with this shift. The result is a filter, not calibrated. Don't get me wrong, land and property, titled and verified, are perfectly sound security, and lenders are right to want it. I've come from the banking industry, and I know how difficult some people can actually borrow and intentionally refuse to pay. So if you have something you're holding on them, that makes your recovery much easier. But requiring them as the default security means credit flows to businesses that happen to hold real property, and not necessarily the businesses that are trading well and have the cash flows. A firm can turn over substantial volumes of money, hold a significant contract with a defined payment date, and still be turned away because the value it has does not sit in an immovable asset. Now, consider what else could reasonably inform a lending decision, even if it does not yet qualify as security in the formal sense. A confirmed purchase order from a large retailer, an export order with an international buyer, a multi-year service agreement with an established firm are all enforceable obligations with identifiable counterparties behind them. There are claims of future income that can be verified today, even though under our current capital framework, they are not yet recognized collateral, the way that a mortgage is or a fixed deposit is. But a lender who can see these obligations, assess the buyer, and structure a facility around the payment timely already has much of what it needs to make that credit decision. What is missing then is not just the lender's judgment. It is the legal and prudential architecture that would let the judgment translate into capital. The assignment framework that makes the claim enforceable ahead of other creditors, and the collateral eligibility rules that will let a bank hold as security rather than treat it for capital purposes if it were unsecured.